Welcome back to Everything Money. We're glad you joined us again. It's Seth, Paul, and Mo. Today we're talking about Sony. We will use our 8 pillars, Paul, these infamous, world-famous 8 pillars that you developed, and we will talk about the financials behind this company. This is a giant, Paul. We love Sony. It's been around forever. You had the Walkman. Mo, you were too young. Forget it. You're only 30-something. But Paul, the Walkman that you put you put it on your belt, then you put the CD in now, and then when they had the non-skippable version, when you
game over.
Game over on the bus. That was the jam, baby. Tell me about Sony and why you like or dislike it, Paul, baby.
All right, so first off, follow us on Instagram. It really helps our egos a lot. So guys, one thing I want to get to on Sony first, another example of a stock was ginormous in 2000. It hit over $150 a share. If I told you in 2000, $150 a share, that 21 years later, it would still be at 115 and get as low as, what is this, $30 a share maybe? You'd be like, you're crazy. Now keep in mind, if I showed you the stock price and said, how do you think their revenue and profit went over the last 21 years? According to the chart, you'd say it was down. Let's go to the income statement. Last year, they did $84 billion. In 2000, they did $59 billion. So it's up. Profit in 2000 was $90 million. Profit in 2012, $10 billion, 100 times more.
Wow.
So guys, this is my exact example when people say, oh, come on, this company's growing, the stock will keep going up. No, this company is growing. Their profit's up 100 times in the last 20 years, and they still collapsed. Their worst profit in the last 20 years was here.
Oddly enough, Paul, go ahead, Mo.
I was going to say, and when it comes to like disruption and stuff, Sony was back then. I mean, they were sound, they were headphones, they were
PlayStation's
gaming systems. I mean, if that was the disruptor of that time.
Check out this article, Paul. This is can Sony keep soaring from September 1999?
I love when you pull up these articles. Seth.
It just ran up 153%. But the article says by the end, look at this, Paul. They said, look at this chart. This is great, right? And then they say that people are assuming the PlayStation 2 is going to sell extremely well and major profit generator over the next 4 to 5 years. We think these expectations have already been priced into a stock, and if you have it, it's a hold, not a buy.
And the funny part is, putting a stock as a sell, especially back then, was unheard of. The hold is essentially the sell. So I'm actually impressed with them saying that. But and by the way, guys, PlayStation 2 was phenomenally successful. PlayStation 3, phenomenally successful. PlayStation 4, and the stock still fell. So anyways, let's do our 8-pillar analysis. Very simple. $142 billion market cap. 5-year PE, just high. 22.76. We want it less than 22.5. Look at this. Very low return on invested capital. So what does this mean? They don't do a good job of investing their debt and equity in the business. To me, this requires a lower multiple of the company, because they're not able to take their cash and put it towards more positive uses to drive up that profit.
We'd like this number over 9.
We want it over 9, so this is an X. So we have 2 X's so far. Seth, look at this.
Adorable.
They do 4.4% dividend, $620 million in dividend costs. Look at this cash flow. It's insane.
Yes.
They've paid less than 10% of their free cash flow in dividends. So again, 2 X's so far. Income statement. Let's look at their revenue growth. That's our next.
Pillar number 3 is revenue growth over the past 5 years, Paul.
71 to 84. Check mark there. 20% increase.
Pillar number 4 is profit growth. Does it follow the revenue?
1.2 to 10.5.
Oh.
Now, I would say this looks like a fluke year. And look at their previous 5 years, Seth. Loss, loss, loss. So this is one of those companies where let's make sure we're cautious about this.
Shares outstanding is pillar number 5. Are they buying back or selling off? They're buying.
No, they're buying, but barely.
Okay.
1.26 to 1.24. It's still a check, but they're not buying back a ton of shares.
If you're sitting at home saying, boy, I've never actually looked at these financials. I've only ever bought a stock and just kind of hoped it goes up. If you did that in the 2000s with Sony, you are still licking your wounds. But we will show you if this resonates. You can have the software behind Paul. You can have it right now by joining our community. Go ahead, Paul.
This software was created because our users kept saying, how do I get access to these financials? So we created the software. And this is what you get with the software. You get the mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content only for subscribers, access to all of us, soon to come real estate calculator. Biggest thing here though is Discord community. We have over 6,100 people with access to be able to talk about their investment ideas with like-minded investors. And all of this for 87 cents a day. If you're serious about your financial future, this is a no-brainer, less than a crappy cup of coffee. Our competitors are $235 a month. This is 87 cents a day. if you are serious, this is the best thing you're going to do. It's going to make your money hundreds of times over in the long run.
Let's get after pillar number 6. This is total liabilities divided by free cash flow. We want this multiple under 5, Paul.
Yes. So what we do here is, guys, we go back to the main page. We pull their 5-year average free cash flow, $7.8 billion. We multiply it by 5. And that equals what, 39 billion, maybe 38 billion, 38 and a half, whatever it is. Call it $39 billion. What we want then is we want the total long-term liabilities to be under this. Why is that? Think about it this way. You and your neighbor both make the same amount of money, have the same house, same cars, same family. But he or she has $10 million in debt and you have 0. Who is more likely to go bankrupt?
Of course.
Of course, it's obvious. Same thing here. We want companies with reasonable amounts of debt, not excessive debt. We have found that this multiple makes sense. It's not set in stone, but we go to the balance sheet, go all the way to the bottom.
Give it to me now.
$125 billion in liabilities. Now, does that mean let's not touch it? No, there could be a lot of things. It means go do more research if you'd like the rest of the company. Okay? So it's still a high number.
Pillar number 7 is free cash flow growth. This is the grandmama of them all, Paul.
And free cash flow is cash from operations less your capital expenditures. It's what the company uses to pay dividends, buy back shares, pay down debt, and pay out and make acquisitions. Thank you very much. So we take the cash from operations less the capital expenditures, $5 billion to 8.27, check mark there. And by the way, look at this. If you look at their profit level, their cash flow is a lot more consistent than their profit. So they probably had write-downs along the way, not necessarily actual losses. And the average is 7.8. Multiply that by 20, and we're left with $157 billion. So we want the market cap less than 157. What is the market cap? It is less than 157.
142, Paul.
Check mark there.
Ooh.
Does that mean you go out and buy it? Not necessarily. We start at 20 as a starting point to say, where do we want the market cap to be? Remember what I said earlier, they have a low return on invested capital. So you want to make sure, and they have low growth. You want to make sure that you're paying an appropriate level for that low return on invested capital and low growth. I think the multiples on Sony should be lower than other multiples for other businesses that have higher growth rates and higher return on invested capital. So once we're done with Mo, let's set on the charts. You're going to see us put this in the stock analyzer tool to see. But if you want to recap quick, you click the 8 pillars tab, comes with the software, tells you all the checks and the X's.
Again, Paul, I go back to the idea, if there was a YouTube around in 2000, there would have been a lot of these experts out there telling you to buy this stock around the 112 to 117 range, and you would have still lost money.
This is an oven mitts stock.
Oven mitts. Get your oven mitts ready. You still would have lost money 20 years later. Zero growth at all. So if you want to trade this quickly and by following some disciplined rules, you can join Mo in the Bid and Ask Nation, Paul. How do we do this, Mo? How do we trade this puppy?
So this one's tough. I'm gonna correlate this over to the daily chart, but you can see the run up that it's had, and you can see this was back on February 5th. That was its all-time high, and since then it's just kind of consolidated in this area. You've seen how many times the stochastic has reversed, and right now it's fighting all-time highs. But zoom out, and we're gonna look at 2 years worth of volume on this thing.
Now, this looks confusing. Walk me through this, Mo.
Now, you can see, if you just look at this thing as one whole, you can kind of see that since here, the volume has just slowly declined. It's been declining over a long period of time. So that tells me that the people are not paying attention to this. And secondly, to break out over this all-time high is going to be very, very difficult. Because what do you need to do that?
You need volume, gas to the car.
If you just look at the 2-year project, it's just coming down. So until this becomes kind of a sexy thing again, I don't know if Sony will ever be sexy again, but that's when I would start paying attention to this. So going into these all-time highs, I would not touch this thing. Even from a shorting perspective, I probably wouldn't touch this thing just because you're not going to get much movement in price. We've seen it over the past, 6, 7, 8 months. So,
Paul, let's open up that stock analyzer tool. We can make future assumptions, project what this company may do in the future, and then say, what should we pay for it now? It's not what you buy, it's what you pay, Paul.
And I'm going to be conservative. Why? I didn't like the return on invested capital. I didn't like that at all. And I didn't like the high debt. So that's already my apprehension. Let's go conservative. My revenue growth numbers. All these assumptions here you see on the screen, but look at this. The PE and the free cash flow levels. My low and middle, I put between 10 and 12 and a half times. Why? Low ROIC, high debt. I want to be as conservative as possible. I hit analyze, and it shows the stock's got to fall pretty much in half. Oh my God, that's too low. Okay, I just see no growth there.
Yeah.
I see a lot of debt. I've got to be conservative here. I see no high ROIC. I got to be conservative. Could I be wrong? Absolutely. But there are 10,000 stocks out there. I want to find the 30 or 40, that 20 to 40 that makes sense to me, that I can sit there and say I'm buying it for a reasonable price and go with that.
That is our take on Sony. Click the link below, get our app, get our software. You can become your family's investing expert in a short amount of time. I know we're speaking a different language trying to follow this. And for you normal folks out there, it takes some practice. You are not going to pick this up in a couple of days. It may take a couple months, maybe even a year. But next thing you know, you'll be flipping open the Everything Money app and showing your friends why they're overpaying on all the companies they're buying right now. So that's our take. Final thumbs up on the way out, and we will see you on the next raging awesome video, Paul. You know I love you, baby.